Thank you for tuning in to Tiger Brokers webinar. So while we are waiting for the rest to join in, I'm Joseph and will be the host for today. Okay, so we give the participants more time to join the webinar. We'll start and begin in about 5 minutes. Yeah. All right, it's 7:03 p.m. We will officially start the webinar now. So hi everyone. Yeah, thank you for taking time to join our Tiger Brokers webinar. I hope you can hear me loud and clear. So today's webinar topic, right, will be about navigating China's equity market. Okay, so I'm Joseph and will be the host for today. So with us today will be James Ooi, who is a market strategist from Tiger Brokers, and Marcus Ng, Vice President at Societe Generale, sharing with us on the investment opportunity in China's recovering market. With that, James, you may begin.
Yeah, let me share the screen first. Just 1 second.
Yep.
Okay, I hope that all of you can see this. Okay, I shall start now. Okay, hi everyone. Thank you for attending the webinar today. I'm James. Just 1 second. Okay, let me quickly go through the disclaimer first. The presentation is provided to you for education and sharing purpose only and does not constitute to any form of advice. So past performance is not indicative of future performance. Okay, so today I will be talking about the outlook for the Chinese equity market. I will cover China-focused ETF, stocks, and Hong Kong DLCs that you may want to consider focusing on. So let me begin with a recap of 2024 performance first. Okay, let's look at the year-to-date return for China equity market. So far this year, the Seng Index is up about 4%, and the FTSE China A50 is also up about 4%. So they are performing quite decent in 2024. When you look at the long-term returns, such as the 5-year or 10-year annualized return, the performance is not so good for Seng Index itself. The 10-year annualized return for the Seng Index is negative 0.15%. In other words, if you have been holding on to a Seng Index ETF for the past 10 years, your average return would have been about negative 0.15% per year. FTSE A50, on the other hand, which includes the stocks listed on Shanghai Stock Exchange and Shenzhen Stock Exchange itself was doing better. The 10-year annualized return for the FTSE A50 is about 7.76%. So which is better than STI index, because STI index only returned about 3.92% on average over the past 10 years. However, if you have been holding on to a US ETF such as S&P 500, your 10-year annualized return is about 12.8%. So I think one of the key takeaway here is China indices have been lagging behind US. I believe the investment strategy is that investor may still like to have some exposure to China, just in case that China equity markets start to playing catch up in performance. But the most important thing is position sizing. I think a 10% to 30% exposure to the China equity market is probably good enough, depending on your risk profile. Okay, let's talk about China outlook. So let's take a closer look at some of the economic data. According to IMF, China GDP is expected to grow by 5% in 2024 and 4.5% in 2025. However, the IMF anticipates China economic growth will slow to about 3.3% by 2029 due to an aging population and slower productivity growth. Having said that, if GDP growth is an indicator of the stock market performance, then the China stock market could still be performing reasonably well over the next few years. However, as China's growth may slow down in the longer term, investors will need to be cautious. Nevertheless, China GDP growth for the next few years is still expected to be among the strongest of the major economies. For example, the GDP growth for China in 2024 is forecasted to be 5%, whereas US is only expected to grow by 2.6%, the Eurozone by 0.9%, and Japan by 0.7% itself. Okay, let's look at China inflation situation. China is currently facing some disinflationary challenges. In July, the CPI year-on-year growth was just 0.5%, and the PPI number declined to about 0.8% year-on-year. However, the silver lining here is with low inflation, there is more room for monetary policy easing because the Chinese government does not need to worry too much about excessive stimulus causing a hotter than expected inflation problem itself. Okay, if we look at PMI number, service PMI was doing okay at 52. On the other hand, China manufacturing PMI is not looking so well. It fell to 49.8 in July, so dipping below 50, which indicates the manufacturing sector is now in contraction. Okay, another indicator to assess the Chinese economy is by looking at the import and export number. So both the export and import are doing quite okay. In the first half of this year, China exports increased by 6.9%, while import rose by 5.2%. The latest July data shows that China import year-on-year growth was 7.2%, while exports grew by 7% year-on-year. So personally, I prefer to see import growth outpacing the export growth. I reckon stronger import growth could suggest stronger domestic demand, indicating that consumers and businesses are spending more on foreign goods and services. So this can be a sign of the economy recovery and expansion itself. Okay, this is probably one of the most important slides. So there is one indicator that I constantly monitor to gauge whether the Chinese equity market is staging a rebound or not. So this indicator is the year-on-year growth spread between M1 and M2 money supply. So I reckon it's quite correlated to the performance of the China indices itself. So the white line here represents the spread between M1 and M2 year-on-year growth. So what does it mean? To put it simply, M1 money supply consists of super liquid money, whereas M2 includes M1 plus another forms of money that are less liquid. So when M1 grows faster than M2, it typically indicates that investors have a positive equity outlook, so they keep their money in the most liquid form, just readily available for investment. So the other line here on the chart represent the MSCI China Index, Hang Seng Index, FTSE China A50 Index itself. So if you take a closer look, you will notice that the indices usually move in tandem with the M1 minus M2 spread. So at the moment, the M1, M2 spread is still trending down. It's not trending upward yet. So which likely explains why we have yet to see a strong rebound in the China equity market. So all in all, based on the economic data I've shown you, it still implies that China is still growing, but probably slower than most analysts anticipated. The recovery itself is just uneven. So this is why a lot of investors are hoping for more fiscal and monetary policies. So I reckon China's stock market will gain some momentum towards the end of the year because policymakers are poised to roll out more stimulus measures aimed at stabilizing growth and deepening the structural reforms in the second half of the year itself. So basically, China leaders say that the fiscal support for the rest of the year will focus on consumption, basically to boost the domestic demand itself. So China equity should perform better towards the end of the year. Okay, so let me briefly talk about the Hang Seng Index. I like Hang Seng Index. I think that it's due for a rebound from the current price. So basically, we could see that the year high of this year for Hang Seng Index is about 19,600, but it has since dropped back to about, I think, 17,000 itself. So these are some of the reasons why you should like Hang Seng Index. So first of all, portfolio diversifications. So the renminbi has depreciated by about 13% against the US dollar since the 2022 low itself. And I reckon some mainland investors, mainland Chinese investors would like to diversify their portfolios into non-renminbi denominated assets to hedge against further renminbi depreciation. So Hong Kong listed stocks in Hong Kong dollars might be one of the top choices. Secondly, China's regulator is adding more Hong Kong listed stocks, ETFs, and REITs into the Stock Connect program. So what is interesting here is that there are currently 24 stocks listed in Hong Kong that are traded in yuan. The 24 stocks will be added to the Stock Connect program, meaning to say, mainland China's investors will be able to buy stocks like Alibaba, Baidu, and JD.com in yuan and sell them in yuan traded currency in the future. Okay, thirdly, the PE ratio for Hang Seng Index is inexpensive at 9.56 times, whereas S&P 500 is trading at 25 times PE ratio. Lastly, Hang Seng Index has been underperforming compared to US markets for the past few years. So there should be some catch up in performance. So what should be some of the best times to accumulate Hang Seng Index related investment products? So probably August and September are some of the better months. Based on seasonalities, over the past 25 years, the Hang Seng Index typically generates negative return in August and September. So the average return was negative 1.4% in August, negative 2.1% in September. However, the average return for October, November, and December were 0.94%, 2.5%, and 1.4% respectively. So based on seasonality, August and September might be good months to accumulate in anticipation for a better fourth quarter. Okay, so one of the most effective ways to gain exposure to China is through ETFs. So here are some of the China ETFs listed on SGX. Okay, there are about 10 China-related ETFs listed on SGX. I won't cover all of them, but I will just share a few examples. So the underlying indices include MSCI China, SSE 50, SSE Dividend Index, China's Index, CSI 1000, Hang Seng Tech Index, just to name a few. If you are considering investing in these ETFs, many of them may appear attractive due to the low valuations. Typically, the PE ratio for China equity market would be around 10 times. Partially because China stock prices have dropped quite a lot in the past few years. On the other hand, if you have a negative outlook on China, or if you are not optimistic about China future prospects, you might consider using short DLCs on China indices or Hong Kong listed stocks in anticipation that they can decline further. But due to time constraint, I will probably focus on Hang Seng Tech Index ETF and SSE Dividend Index ETF now. Okay, let's talk about the Lion OCBC Securities Hang Seng Tech ETF first. I believe most of you are familiar with the Hang Seng Tech Index. So basically, the index itself tracks the 30 largest technology companies listed in Hong Kong. So in my opinion, this is a better version of the Hang Seng Index. So some familiar names in the Hang Seng Tech Index includes Alibaba, Meituan, Tencent, Xiaomi, JD.com, Kuaishou, Li Auto. One commonly asked question I often get is whether BYD is included in the Hang Seng Tech Index itself. The answer is no. The company included in the Hang Seng Tech Index is BYD Electronic, not the parent company BYD. If you want to gain exposure to BYD, one of the better products on SGX to consider is the BYD stock DLC by SocGen listed on SGX itself. So here are some of the details about the Hang Seng Tech ETF. Again, I won't go through one by one, but the most important thing to note is that Hang Seng Tech ETF includes both the Sing and US dollar traded currency options. So as a Singapore investor, the most attractive proposition is the Sing dollar denominated ETF, which allows you to buy using Sing dollar, and when you sell, you can sell and receive Sing dollar in terms of sales proceed. To me, the main investment thesis for the Hang Seng Tech is the AI optimism, earnings upgrade, and the inexpensive valuations at the moment. But the main risk is the potential US and China tech war. Okay, another interesting ETF is the CSOP Huatai Pine Bridge SSE Dividend Index ETF. So this is a feeder fund which invests about 90% of the NAV in the Huatai Pine Bridge SSE Dividend Index ETF itself. So the underlying index is the SSE Dividend Index. Basically, it tracks the 50 companies listed on the Shanghai Stock Exchange that pay high and steady cash dividends. To put it simply, the index tracks the performance of high dividend paying companies on the Shanghai Stock Exchange. Okay, if you remember from my earlier slides, the SSE index is one of the best performing indices itself. So the year-to-date return is about 10%, outperforming the rest, and the 10-year annualized return is quite good at 10.6% itself. So why does the SSE Dividend Index outperform? So personally, I believe the main reason is the concept of 中特估, which is 中国特色估值. There is no there is no official English translation. But I think the best term to describe it is valuations with Chinese characteristics. So the term itself was created last year by Yi Huiman, so the chairman of the China Securities Regulatory Commission. So to put it simply, he suggests applying a different valuation approach that consider the unique characteristics, policies, economic conditions specific to China when evaluating the Chinese SOE state-owned enterprises itself. So traditional valuation method might not fully capture the factors influencing the Chinese markets. So SSE Dividend Index benefits. The second reason is that Chinese dividend stocks have become attractive to investors due to lukewarm economic outlook in China. So because the economy has slowed down, the growth stocks currently face limited growth prospects, so investors may prefer dividend-paying stocks. Okay, finally, there has been an upgrade in the dividend payouts, which has led investors to be more willingly to apply a higher valuations to the stocks itself, to the dividend-paying stock itself. So let's look at the sectors breakdown. The finance sector accounts for about 26% of the total weight, while mining makes up 23%, manufacturing comprises 22%. So you can see that this ETF focuses on all economy sectors. So these are the top 10 holdings of this ETF, which are mostly all economy stocks. So the less attractive aspect of this ETF is also quite obvious. It mainly focuses on old economy stocks. So if you prefer new economy stocks, this ETF might not be appealing to you. So currently, this ETF only offers Sing dollar as the traded currency. The total expense ratio is about 1.53% itself per annum. However, It's a new ETF, so 1.53%, even though it's quite high, it may change over time. So in summary, I like this ETF based on the track record. It is one of the best performing index, but it consists of old economy sector. So you probably need to study some of the underlying stocks to build your own conviction itself. Okay, next, I'd like to quickly talk about NIO. So NIO is currently listed on SGX, US, and Hong Kong Stock Exchange itself. I want to show you the share price performance of NIO on the US Stock Exchange because it has a longer trading history. So we can see from the performance here, the share price has been quite volatile. In 2020, the share price increased by more than 1,000%. However, it has not been performing well since then. And the year-to-date return for 2024 is down about 57%, mainly due to the overall struggle in the China EV market itself. So Tesla stock has also dropped significantly. So when Tesla underperforms, other Chinese EV companies tend to follow suit. Okay, some potential upside catalysts for NIO includes the upcoming launch of the new low-cost model Onvo L60 in the late September itself. So the launch is expected to drive the revenue growth. Additionally, there could be a potential expansion in the gross profit margins itself. So a few quarters ago, NIO gross profit margin was just 1%, but it has recently improved to about 4.9%, suggesting the worst might be over. However, NIO is facing intense EV competition in China. Because of this, I think that NIO may continue to struggle this year and probably next year as well. So given the history of volatile stock prices, it might be more suitable for short-term trading at the moment. So the stock is currently forming it's currently near the bottom itself, and you can probably, based on the support and the resistance level, to build your own entry and exit level itself. Okay, next, I want to share with you about DLC. So especially some of the short-term contra trading strategies using DLC. So basically, if you intend to conduct some short-term trading on stocks, ETF or DLCs, so other than using the normal cash account or margin account, you can also use the cash boost account to do some contra trading. So you do not need to fork out cash upfront to conduct some buy and sell trading in the short term. So for more details, you can go to our Tiger app to find out more. Okay, one of the short-term strategies is hedging. So you can buy a daily short DLC to hedge your position if you think that the market will decline. For example, this few days, the market has been quite volatile. So DLC would have been useful to hedge your portfolio against any short-term downtrend itself. So personally, I like to hedge my portfolio when I'm unsure about a particular event, such as the earnings announcement or an economic event. You might as well hedge. So you can hedge your individual stock positions, or you can hedge the entire portfolio. For example, the Hong Kong listed stock Meituan is expected to release the earnings next week on 22nd of August at 7 p.m. So which is next Thursday, 7 p.m. If you believe that the earnings result will be poor, will be bad for Meituan, and you believe Meituan stock in your portfolio will drop after the earnings releases, you can buy a Meituan daily short DLC to hedge your Meituan stock position. So my preferred hedging method is that I would probably buy this inverse 5 times DLC before the market closes on August 22nd, just right before the earnings announcement at 7 p.m. And I will exit the DLC position on the next trading day. I will likely get out of it within the first hour of trading the next trading day, as I normally assume that the market would have fully digested the negative earnings outlook within the first hour of trading and is probably ready to resume the uptrend itself. But some investors may prefer to hold on for the next few days as they believe that the bad earnings news itself may negatively affect the stock price for a couple more days. But just remember that DLC are probably best suited for short-term tradings and not for long-term trading itself, because they could be a bit costly to hold overnight. So other than hedging the individual stock positions, I also like to hedge my entire portfolio. So if your portfolio is super correlated to the Hang Seng Tech Index or the Hang Seng Index, probably you can engage with inverse 7 times Hang Seng Tech Index DLC or Hang Seng Index DLC to hedge your portfolio. For example, recently the stock market dropped a lot due to potential US economic hard landing or the unwinding of the yen carry trade. So you might want to hedge your entire portfolio. So other than hedging, I believe most investors use DLC for short-term speculations. You can buy a daily short or long DLC itself. You can base your decision on fundamental or technical analysis. Okay, let me go through some of the technical analysis on some of the Hong Kong stocks and indices. So basically, you can use these support and resistance levels that I show you when you stage your entry and exit price for the DLC itself. Okay, let's talk about the Hang Seng Index first. So to me, about 18,000 is a meaningful technical level. As long as Hang Seng Index is below the 18,000, I reckon it's bearish, and the entry strategy below 18,000 should focus on short positions. But if Hang Seng Index is above 18,000 itself, I would say that the outlook would be mid to long-term bullish. You should probably focus on long positions. I reckon if it can stay above 18,000, there is a good chance that it could rise to 20,000 or even higher. For example, one of the entry strategy is to go long the DLC when the Hang Seng Index go past the resistance levels such as 19,680, 18747 itself. So when it go past this level, probably it's an entry level for your DLC. And here I'd also like to show you the Hang Seng Tech Index. So I have drawn the Fibonacci retracement from the 2022 June high to the 2022 low. So based on the Fibonacci retracement, these are the support and resistance levels where you can find trading opportunities. The current price is about 3413, and it has just rebounded from the low of 3290. I think that the Hang Seng Tech Index may continue to trend higher, potentially reaching the next resistance of 3643 price level. But when it reached the 3643 price level, you need to be careful. If the Hang Seng Tech Index go down again and break the 3290 support level, because it will form a head and shoulders pattern. But I would say that there's no need to worry too much just yet. I believe you will only see a break below 3,000 or even 2,700 levels in the case of an economic hard landing. But I really don't see an economic hard landing scenario happening at the moment. Okay, let me quickly go through Xiaomi. So Xiaomi has garnered a lot of investor interest since it launched its electric vehicles. So basically, the fundamental story about Xiaomi is the PE expansion, higher profitability due to the EV and the smartphone sales itself. Having said that, I think that the main strategy here is that investor could try to set up a long DLC position when Xiaomi actually come down in prices itself, because the largest trend here is still up. So these are some of the support or resistance level. Basically, this webinar replay will be available online. So if you are interested to look back all these resistance and support levels, you can look back at the webinar replay available on Tiger app or even YouTube itself. Okay, now let me quickly go through the BYD. So I like BYD a lot. If you want to gain exposure to the Chinese EV market, BYD would be one of the top choices. The key risk for BYD is that the car sales mainly come from the Chinese market. I believe BYD generates about 13 or 15% of the car sales overseas. So if China economy continues to slow down, BYD will suffer. Additionally, BYD does not disclose the profit margin for the electric vehicles. So you just do not know how profitable the EV segment is. From a technical analysis perspective, it looked a bit like it's forming a double top or head and shoulder pattern itself. But I think it could also form a bullish flat pattern or a wedge pattern itself. If you are patient, you could wait for a successful breakout above $230, 230 Hong Kong dollar, before setting up your long DLC position on BYD. Okay, let me talk about Alibaba. So to me, Alibaba is one of the best stocks to perform short-term trading because the stock price does not seem to go anywhere. It's a sideways market for Alibaba itself. I would say that it looked like a sideways market. So basically, you can actually base on this resistance or support level to trade. Long-term wise, I don't think that it's going anywhere itself. It could be just hovering around the price level here. Okay, so next let's talk about Meituan. So the current price is about $102 Hong Kong dollars. Personally, I think that the $100 would be a strong psychological support level for Meituan. So the immediate resistance would be about 130 at the top here or 144. And if you really enter at around $100, you may like to hold on until about 130 or 144 itself. And this is the last one. This is Tencent. Tencent is my favorite Hong Kong stock. So it has a strong company moats. I am still waiting for Tencent to close above 384 Hong Kong dollar, because it would successfully form a flat pattern. When that happens, I think it could probably go up even higher to reach my best case scenario, 503 Hong Kong dollar. Okay, that would be all for me. So over to you, Joseph and Marcus.
Hey, hi, James. Thanks. Hope you can hear me clearly, everyone. Let me turn on my video. Hi, everyone. Hi. My name is Marcus. I'm from Societe Generale. We are the issuer of the DLCs that James has mentioned a few times in his presentation so far. So in the next 15 to 20 minutes, maybe 15 minutes, I'll try to be fast. We'd like to give you a quick overview of what the DLCs are. I already see a question inside there in the chat that how is a short DLC different from a put option? It's entirely different. So this 15 minutes, 20 minutes, hopefully I can give you a good view of what the DLCs are and what they can offer you. Okay, so let me share my slides. Do prepare some slides for this. Over here. Okay, guys, I hope you can see my slides. All right, so DLC stands for Daily Leverage Certificate. All right, so this DLC is a leverage short-term trading instrument that is listed on the SGX securities market. So which means that you can access it through you can trade it through any regular stock brokerage account, including Tiger Broker's account. You can go into your Tiger Broker's account and trade the DLCs. So you just look up the stock code or the 4-character code of the DLCs that you want, and then you go and trade it on Tiger Broker's trading platform. All right, you don't trade it with SocGen. You don't trade it on any SocGen account, etc. You don't need to open any separate account. You can trade it directly on any regular stock brokerage account, including Tiger Broker's trading platform. Okay, so the DLCs are listed on the SGX securities market. Okay, it is a short-term trading instrument with gives you a fixed daily leverage on the underlying stock or underlying index daily performance. All right. So these DLCs come in 2 types of DLCs. One is a long DLC and one is a short DLC. All right. So you can express your bullish or bearish view on the underlying asset using either the long DLC or the short DLC. If you are bullish on Alibaba, you will buy the long DLC on Alibaba. Or if you are bearish on Alibaba, you will buy the short DLC that tracks the Alibaba. Okay, so 2 types. Whatever it is, you always initiate your position with a buy trade. You either buy a long DLC if you're bullish, or you buy a short DLC if you are bearish on the underlying asset. All right, fixed daily leverage. We have up to 7 times leverage for our index underlying DLCs. So the DLCs that track the Seng Index or the Seng Index, we have 5 times and 7 times DLCs on them. For single stock DLCs like Tencent, Alibaba, etc., we do have 5 times long and short DLCs on the single stock names. All right, so all the DLCs will track an underlying asset, either an index or a single stock, and we cover a wide range of Singapore, Hong Kong indices and single stocks, and US indices, which I will touch on later. Okay, so the DLCs are all traded on SGX securities market, where SocGen, we are the issuer, we list it on SGX securities market, and we offer liquidity by being a designated market maker. So this designated market maker is a regulatory obligation where we are obliged to provide continuous liquidity throughout the trading day for investors to buy and sell the DLCs as long as the underlying asset is open for trading. So Hong Kong stocks, 9:30 a.m. they open and they close at 4 p.m. So we will only provide quotes on the Hong Kong names DLCs from 9:30 a.m. to 4 p.m. even though the SGX market is open from 9 a.m. to 5 p.m. So only transact on the DLCs when you know that the underlying asset has opened for trading. Okay, so we provide the liquidity every day. You are buying and selling with SocGen. We provide the bid and ask quotes for you to buy and sell the DLCs. So a common misconception is that people always look at some of the DLCs. We have over 200 DLCs listed, and not every one of them are traded every day. All right. So for example, today in vogue or in favor could be Alibaba DLCs, but our Kuaishou DLCs maybe today not popular and it's not traded. no one has traded on the Kuaishou DLC today, but it doesn't mean that you can't be the first one to go and trade on the Kuaishou DLC today, because there's always liquidity there for you on the bid and ask prices and the bid and ask volumes that SocGen will provide on the Kuaishou DLC for you to buy and sell the DLC, even though there might not have been any turnover or any traded value on that DLC for that day so far. All right. So always look at the bid and ask prices and the bid and ask volumes, not always on the turnover. So do look out for that. That liquidity is essentially the bid and ask prices and the bid and ask volumes that SocGen is obliged to provide every day for all our DLCs. Okay, so I mentioned that we have over 200 DLCs listed on SGX, and it covers Hong Kong, Singapore indices and stocks. So Hong Kong indices, we have your Seng Index, Seng Tech Index, as well as the Seng China Enterprises Index. Singapore index, we have the Simsky Index, the STI Index. Single stock, all the big names, big blue chip names, we do have them. 5 times long and short DLCs on them. So big tech giants, Tencent, Alibaba, Meituan, which James mentioned a bit about just now. We do have the 5 times long and short DLCs on them. Singapore names, mainly the STI constituent stocks, DBS, Timor Banks, Venture, CapitaLand. We do have the DLCs on them as well. And our latest addition have been the US index DLCs. So we have 5 times and 7 times DLCs, long and short, on the NASDAQ, S&P 100, S&P 500, and the Dow Jones Index. Okay. So our most popular traded DLCs are the 7 times and 5 times DLCs on the Hang Seng Tech Index. So I think the volatility is there on the Hang Seng Tech Index. That's why it's been very popular among our DLC traders. They trade it intraday, they trade it over a few days or a few weeks. But as James mentioned just now, the DLCs is a short-term trading instrument. Intraday, a few days, a few weeks, but do not hold on to the DLCs for months at end. Okay, so it's a short-term trading instrument to capture short-term opportunities in the market. And for some of these more volatile underlying, such as the Hang Seng Tech Index, there are plenty of opportunities for active traders out there to trade using the DLCs. Okay, so the DLC, the basics of it, the payoff is very much like a leverage and inverse ETF. For those of you who are familiar with the TQQQ or the SQQQ in the US, you know, the ProShares Ultra 3 times and long and short ETF on the NASDAQ. Well, these DLCs have exactly the same payoff as the leverage and inverse ETF, same as the TQQQ or the SQQQ, where you give that fixed leverage performance of the daily performance of the underlying asset every day on a close-to-close basis. All right. So the payoff is exactly like a leverage and inverse ETF, but just that we can go higher in terms of leverage. All right. So most of the leverage and inverse ETFs out there in the market, they are restricted in terms of the leverage, where it's only about 2 times or 3 times. But for the DLCs, we go up to 5 times or 7 times leverage on the DLCs being a certificate structure and not a fund structure. All right. So in this example over here, you can see that BYD is up 2% on day 2 versus day 1. So on a close-to-close basis, BYD is up by 2%. My 5 times long, BYD DLC is up by 10%, all right? So 2% times by 5 times leverage is 10%. So my long DLC is up by 10%, while my short DLC is down by 10%. So this happens every day on a close-to-close basis, where my long DLC and my short DLCs will give you that 5 times performance of the underlying assets daily percentage performance every day on a close-to-close basis. So that's basically how the payoff of the DLCs work. There is no optionality impact. So this is where it differs from an option. Options, you have that optionality kind of concept where you have the at the money, in the money, out of the money concept. You have the strike price. You have time decay. The DLCs does not have that kind of option pricing. All right, so it's not an option at all. It doesn't have all this kind of at the money, in the money, out of the money, or different strike prices. The long DLC and the short DLC just basically replicates the underlying assets daily percentage performance by that fixed leverage factor every day on a close-to-close basis. Okay, so that is the basic principle of how the DLCs provide the leverage and how the performance of the DLC is expected to perform every day on a close-to-close basis versus the underlying stock or underlying index. So this is an example over here. The DLCs are generally priced between 20 cents and $2 Singapore dollars. So they're all traded on SGX in Singapore dollar terms. It's generally priced between 20 cents to $2. So in this case, the example over here, the DKPW is the stock code for the Alibaba long DLC. This Alibaba 5 times long DLC, the stock code is DKPW. So if you want to go long on Alibaba, you can choose this DKPW. You will go on to Tiger Brokers trading platform, search for DKPW. you should be able to retrieve this Alibaba long DLC, and then you can buy and sell on the Tiger Brokers platform. All right. So the name of the DLC tells you a lot about the DLC, what it offers you. So at the beginning of the DLC name, it always is the underlying asset, whether is it Alibaba, whether is it Meituan, or whether is it Seng Index, HSI. It'll be stated at the front of the DLC name, followed by the fixed leverage factor that it offers, 5 times or 7 times, and then followed by the whether it's a long DLC or a short DLC. Remember, if you're bullish, you buy the long DLC. If you're bearish, you buy the short DLC. Okay, and then SG stands for Societe Generale. We are the issuer of these DLCs, and then followed by the expiry date in year, month, date format. The expiry of the DLC is usually long dated, 1 year, 2 years, or 3 years. But please do not hold the DLCs for 1 year, 2 years, or 3 years. It is meant to be a short-term trading instrument, few days, a few weeks maximum. Okay, so over here you can see in this screenshot, it's a particular day on 23rd of January this year, where Alibaba stock was up by 1.45% at about 9:55 a.m., just 25 minutes after the Hong Kong market opened. So Alibaba was up by 1.45%, and you can see that the DLC here is up by around 5 times that of the Alibaba stock performance, where it's up by 7.65% versus its previous close. So that's where the 5 times performance is, right? So every day, you know, this price of this DLC, whether it's at 20 cents level, whether it's at $1 level, it will move in line with the underlying stock's daily percentage performance multiplied by the leverage factor, either 5 times or 7 times. Okay, so Alibaba was up, and therefore Alibaba long DLC was up. But over here, the Alibaba 5 times short DLC, DFTW, was down by 7.36% similarly. So if you got direction correct, you know, you buy the long DLC and the Alibaba stock moves up, you would be able to see a gain in your long DLC and be able to capitalize and make a profit. But if you have bought the short DLC instead, and Alibaba went up, then you will be sitting on losses of a similar magnitude as the long DLC. All right. So the moves on Hong Kong stocks can be quite big, and with 5 times leverage, of course, as what mentioned James just now, position sizing is very important, especially when doing with trading leverage products like this. So please exercise your trade discipline and proper position sizing. Remember that if you buy $1,000 worth of, say, this Alibaba short DLC DFTW, so I buy $1,000 worth of this DFTW, you are getting $5,000 worth of notional exposure to Alibaba stock because of the 5 times leverage. So it's as though you are buying 5,000 worth of the Alibaba stock itself, the exposure. So remember that $1,000 gives you that $5,000 kind of notional exposure on the underlying stock. Okay. All right. So a lot of people use the DLCs to trade, to get access to the Hong Kong stocks, right? So you have the familiarity and the comfort and the convenience of trading it on the SGX. So of course the DLCs are listed on SGX, so you trade it in Singapore dollar terms. You are familiar with the microstructure or the setup of the SGX. You know, the lot size is 100 certificates, same as your DBS shares or your UOB shares. It's the same 100 unit bought lots. Okay, and then you are charged SGX exchange fees, etc. So you have that convenience, that familiarity of trading it, this instrument on the SGX, but getting exposure to Hong Kong stocks. And also with these DLCs comes certain benefits in terms of trading Hong Kong stocks. So one is definitely the capital and the cost efficiency. With a bought lot unit size of 100 units, and then DLCs are priced generally 20 cents to $2. So take for example $1. So you can buy the DLC for as little as $100, right? And by having that $100, you are able to scale into your position. You might be able to trade in smaller size units, because I think most of us know that in Hong Kong stocks it's not that cheap, or your capital outlay might be quite high in terms of trading Hong Kong stocks. For example, BYD stocks over here in Hong Kong, if you want to buy the BYD stock in Hong Kong, there's a higher minimum investment sum due to the bought lot unit size. So it could be 10, 15K. In this example here, it's 18K Singapore dollars just to get exposure to BYD stock. It could be lower now, given that BYD stock might have dropped a bit. But 18K Singapore dollars is not exactly a very small sum if you want to get exposure to BYD. But that's the minimum investment sum if you want to trade and buy BYD stock on Hong Kong Exchange. But you can use the BYD DLCs to gain exposure to BYD for as little as a few $100s, and you can scale in your position. You can put into a few tranches, even to build up your position, instead of having to one lump sum put $18,000 into BYD stock. All right, and it's particularly important as well for active traders, for traders who are short term. You trade it in and out within the day itself, intraday trade in and out, or you want to hold it, or you trade it a few times a week. The cost could be quite expensive if you were to be trading on the stock itself. But the BYD DLCs will offer you that capital efficiency and hence that cost efficiency, because the transaction cost is charged on the amount that you pay to buy the premium that you pay to buy the BYD DLCs. So you want to get $10,000 exposure to BYD stock, you only need to buy $2,000 worth of the BYD DLCs, and you are charged only on that $2,000. So there is that capital and cost efficiency when using the DLCs to trade Hong Kong stocks. And also you are paying SGX exchange fees. You're not paying the Hong Kong exchange fees, the stamp duty. You are paying SGX exchange fees only, which is 8 times cheaper than the SGX fees that you pay to trade DBS Singapore shares. SGX has a very much lower exchange fee for the DLCs, 8 times cheaper than the exchange fees that you pay to trade the DBS or Singapore shares stock, because they do see it as a short-term trading instrument as well. So there are multiple benefits, and people see that. That's why people use the DLCs to trade Hong Kong stocks or gain exposure to Hong Kong stocks, especially for those who are more active traders. All right, but a few things to look out for is definitely, as I mentioned just now, the market making hours is only restricted to 9:30 a.m. to 4 p.m. during when the Hong Kong market is open. So we'll only provide quotes between 9:30 a.m. and 4 p.m. And also, you're still subjected to the foreign exchange risk on Hong Kong dollars on this DLCs when trading Hong Kong stocks. Okay, so I mentioned just now that there are a few trading strategies: day trading, swing trading, hedging, and also I think James touched on it a bit. In interest of time, I'll try to speed through this a bit. So it's quite straightforward. If in this example over here for intraday trade, a day trading example, for the DLC, say on this particular day on 11th of January 2024, in the morning at market open, I see that the 7 times long Hang Seng Tech DLC ILKW is quoting it around 50 cents. Okay, I buy it. I try to buy it in anticipation that the Hang Seng Index would start to appreciate throughout the day. And indeed, the Hang Seng Index managed to gain about 3% during the day. From 9:15 a.m. to just shortly after lunch, 1:45 p.m., Hang Seng Index gained 3%. My 7 times long Hang Seng Index DLC has gained in value from 50 cents to 61 cents. That's a 21% gain, in line with that 7 times fixed leverage factor. And so I can sell off my DLC back to SocGen at 61 cents in the afternoon to get that 21% profit. So simple intraday trade that we do see a lot on our DLCs. Then we do have the swing trade where people hold it for a few days, or a week or a few weeks. So this example over here, the Tencent, it gained 13% between 5th March to 28th March. So this is 17 trading days. And to capitalize on this gain, investors who bought the 5 times long Tencent DLC DUWW would see that the value of this DUWW had risen from 4.9 cents to 8.5 cents during this 17 trading day period. That's a 73% gain on the DUWW on the back of Tencent gaining 13%. All right. For those of you who are sharp, you will see that 13% times by 5, that is only about a 65% gain, right? How come my 5 times long Tencent DLC is up by 73%? Well, so the 5 times performance works on a close-to-close basis, but when you hold the DLC for more than a day, for a few days or a few weeks, there is this compounding effect features where your gains or losses are compounded every day. And so in this case here, in a nice uptrend like this, 5 times long Tencent DLC DUWW managed to have a compounded gains up to more than the 5 times performance of the underlying stocks performance. Okay, so hedging example is just the opposite of it. If I hold a big bag of Alibaba stocks that I want to hold for the long term, but I do see impending correction on the Alibaba stocks, I can use the 5 times short Alibaba DLCs to make some gains to offset my paper losses on my Alibaba stock portfolio. All right, so this one, pretty straightforward in terms of using the 5x short DLCs, but the key in this is to make sure that you know what the exposure is. Like I mentioned just now, you buy $1,000 worth of Alibaba short DLC, you are actually getting $5,000 exposure to Alibaba stock itself. So important to know what is your stock portfolio exposure and how much of the DLC you have to buy to have that same equivalent exposure to do a proper hedge. All right. So short-term hedging only. So do be careful when you are going using the short DLCs for hedging purposes. Okay. So compounding effect, I need to touch on this before I can go straight into a bit more of where to find out more information about the DLCs. This is the key, very important feature of the DLCs, the compounding effect, which I just mentioned just now. So the compounding effect can work for you in a nice trending market, but it can work against you in a volatile or sideways market. All right. So in this example over here on the table on the left, you can see that the underlying is up by 1% on day 1, up by 2% on day 2, and then up by another 2% on day 3. So 3 consecutive days of gains, 1%, 2%, 2%. All right. Every day, my DLC will give you that 5x performance, being a 5x DLC. So my 5x long DLC would be up 5% on day 1, up 10% on day 2, and up another 10% on day 3 because underlying is up 2%, 2%. All right. So every day you get that 5x performance of the underlying assets, daily percentage performance. But cumulatively over the 3 days, the underlying is up by 5.08%, but my DLC is up by 27.05%. So 5% plus by 5 is 25%, but my DLC is up by 27%. The extra 2% gain that you get is due to the compounding effect or the compounded gains, because my 10% gain on the second day is based off a higher base of $2.63 on the close on day 1, and my 10% gain on day 3 is off a higher base of $2.89 as a close on day 2. So that is the compounded gains. Every day your gains and losses are locked in. So there is that compounding effect that can give you more than a 5x performance if you manage to capture a nice uptrend or a nice trending market on the underlying asset. Okay, so that's where it worked for you. In a nice trending market, the DLC gives you more than that 5x or more than that fixed leverage factor to give you additional gains or compounded gains. But in a sideways or volatile market, in the table on the right over here, you can see that on day 1, underlying is up by 2%, day 2 is down by 4%, and day 3 is up by 7.31%. It rebounded back on day 3 after the drop on day 2 to give an overall cumulative gain of 5.08% over the 3 consecutive days. My 5x long DLC, every day I get the same 5x performance. Day 1 up 10%, day 2 down 20%, day 3 up by another 35%. All right, but cumulatively over the 3 trading days, my DLC is only up by 20%. So 5% times by 5, you can see that this 5x long DLC gave less than that 5x fixed leverage factor because of the compounded effect when you hold the DLC for more than a day. So that's where the DLCs might not work best for you in a volatile or sideways market where the compounding effect can work against you. Okay, that's another reason why also the DLCs are not designed for a long-term buy and hold kind of trading, because these DLCs, the compounding effect, will work against you in the long run because markets don't move in one direction in the long run. In the long run, there's such thing as mean reversion. Markets always come back to the mean. So in the long run, markets don't move in one direction only, and that's where the compounding effect will work against you in a sideways moving market. Okay, so compounding effect, very, very important for you to understand. It's the same kind of feature that you have on your TQQQ or SQQQ or leverage inverse ETF. So all the fixed leverage products out there will be this compounding effect that you have to understand before you trade it. So you can find more information on our website, more illustration on the compounding effect that you can understand and internalize before you trade the DLCs. Okay, so the DLCs I mentioned just now, comparison to other leverage products out there, there is a bit of, I mentioned a bit about how this is different from options. So these DLCs are not an option product. So these DLCs do not have the time decay, implied volatility, no add the money, in the money, out the money kind of concept. Again, I stress it is just very much like a leverage inverse ETF where every day you get that fixed leverage on the underlying assets, daily percentage performance. Okay, and it's also not like a CFD. Another type of leverage product out there, a very popular leverage product out there. So the DLCs are exchange traded, it's traded on the SGX, and it's not a margin product. All right, the CFDs are OTC or over the counter kind of product, they're not listed. and they have the risk of a margin call because they have margin products. So margin call is when the underlying moves adversely against you, and you could face the risk of a margin call. Your broker asking you to, your CFD provider asking you to top up your margin. Otherwise, they might liquidate your position. Well, there is no such thing as a margin call on the DLCs because it's not a margin product. All right. So for DLCs, if I put in $1,000, if I buy $1,000 worth of DLC, that is the most I can lose. I will not be asked to top up any margin, or I will not face any bigger losses than my initial investment amount, because of the underlying move adversely against you. I will not be asked to bear that losses. All right, so your max loss is kept at 100% when it comes to the DLCs as opposed to margin products. Okay. So there are other features such as the add-back mechanism, which I don't have time to touch on. This one, please do read up on our website. So let me just quickly show you our website. So that you have nowhere to find out more resources on the DLCs. Definitely for anyone who is trading the DLCs, I cannot stress enough that you should visit our website to understand, to view the tools that we have on our website, the DLC website, dlc.socgen.com, to find out more about the DLCs. This is our website over here. So this is our homepage, and a very important information on our homepage is the top right-hand corner, the DLC hotline. So please do call our hotline 6226-2828. If you have any questions at all about the DLCs, my team and I are on standby during market hours 9 a.m. to 5 p.m. for you to answer any questions, any feedback that you have on the DLCs, to answer them, and to make sure that you fully understand the DLCs before you trade them. So you can find more information on our education tab over here. We do have a lot of content over here, as well as videos, including some of the videos here, how to select the right DLC for target exposure. That's one of our most popular videos. So please do watch this video, how to select the right DLC for your target exposure before you trade the DLCs. Very, very important. Okay, so the videos and also FAQs for you to find out more about the DLCs before you trade them. Under the products tab, you can find all our DLCs, all 210 DLCs that we have listed on SGX. So over here, you can search for the underlying, the type, long or short, or the leverage factor before you trade them. All right. So if you look for Alibaba, if you want to go long on Alibaba DLC, for example, Alibaba, you can choose from the range of Alibaba DLCs over here. All right. There are a few versions of the Alibaba DLCs on the long or the short side. So we have over here 5 long Alibaba DLCs, all at different price ranges. One at 10 cents, one at 80 cents. So you do have to watch that video, how to select the right DLC for target exposure, because that will tell you about the sensitivity of the DLC, which is the most sensitive DLC, and which is the most appropriate DLC for your target exposure. All right. But if in doubt, always just look at the red star indicator over here on the left. So if you're looking to long Alibaba DLC or long Alibaba, go long on Alibaba, you would choose the long Alibaba DLC over here with the red star indicator and the stock code 905W. All right. So if in doubt, look for the red star indicator as to which 5 times long Alibaba DLC to trade, to gain that long exposure to Alibaba. Okay, so running out of time, I want to be able to answer for the Q&A. So I'll stop here. Do visit our website, dlc.socgen.com. Give us a call if you have any questions on the DLCs. You cannot learn it all in 20 minutes. So take your time and do reach out to us if you have any further queries. All right, thank you.
All right, you can hear me clear. So once again, we've got to thank James and Marcus for the insightful sharing, especially on the China market and especially on DLC. Okay, so right now we'll cater probably 10 minutes to answer some of your questions. Okay, so one of the questions is it time to buy into Chinese equities, and will it ever go back to the levels that we have seen before?
Yeah, probably I take the question first. Okay,
go ahead.
Yeah, I think it will go back to the price level we had seen before, but I just do not know how long it will take. So to me, if investor wants to push China stocks up, it's better that they do it within these few years, because in longer term, the main risk is that China will have an aging population problem. And the aging population is a structural problem that is super hard to deal with. So as to the questions, is it time to buy now, right? Yeah,
buy into Chinese equities right now? Yes.
okay. So I think we have seen the worst in the economic data itself, and some of the China stocks have been bottoming out. So I guess China stocks would be probably higher towards the end of the year. Again, no one is sure about that. The key is to control your position sizing. Do not overexpose yourself in China equity market, either via stocks or DLC or even ETF itself. Yeah, that would be for me.
All right. So another question is by Denise. Where are the DLCs found in? Marcus, one thing.
Yes, so the DLCs are issued by SocGen, and we list it on the SGX securities market. All right, so we list it on the SGX securities market where investors can buy and sell them using any regular stock brokerage account. You can trade in through your regular stock brokerage account the same way that you would trade your DBS shares or your UOB shares. In the same account, you can find the DLCs as well. So look out for the 4-character stock code, go into your trading platform and search for it. So go and try it out on Tiger Broker's trading platform. Search for the DBS long DLC or the BYD long DLC. Search for a DLC using the 4-character stock code. You should be able to find it there. If you don't, give me a call. All right, give us a call on our hotline. You should be able to find the DLCs on your Tiger Broker's trading platform.
All right. So I think, Marcus, we got another question is how would you suggest the entry point for DLC?
Okay. This one is very important, all right? So you do not conduct your technical analysis or your charting on the price on the stock chart of the DLCs itself, on the price chart of the DLCs itself. Okay. You should not be looking at the price chart of the DLCs. You should not be doing your technical analysis on the DLC price chart. You should be doing your technical analysis on the underlying stocks price chart. Okay. So you do your technical analysis, and when you think that the underlying stock is, you find that buy entry. So if you think that's the entry point for you on the underlying stocks price chart, then you look at the corresponding 5 times long or 5 times short DLC to enter your position. Okay. So you do not time your entry into the DLC based on the DLC price chart. You should time it based on the underlying stock. So when the underlying stock is trading at, say, this level, at this point in time today, the DLC, you should see that same 5 times performance based on the percentage. And then that's when you can look at the bid and ask codes that SocGen provides that updates real time based on the underlying stocks performance on the day, intraday. It will update real time. We provide codes as the underlying moves during the day. We will update the DLC price throughout the day. So when you time to put a trigger on the underlying stock, you look at the DLC, that bid and ask price is reflective of the current market price of the underlying stock, and you can buy and sell the DLC then. Okay.
Yeah, just something to add to that. I do realize that SocGen actually provide quite tight bid and ask spread itself, and then I think the liquidity is quite there. Yeah.
Yes, James. I mean, for SocGen, we other than being heavily regulated by the exchange to make sure that we offer competitive bid and offer codes, we also pride ourselves on the liquidity quality or the liquidity provision that we provide. Spreads wise, I think to be realistic, for like the big China tech giants, Tencent, Alibaba, the DLCs, you should not expect more than, you should expect around a 1% spread for a 5 times leverage. All right. But for the Singapore stocks, DBS, Singapore banks aside, which is very, very liquid, for the other Singapore stocks, you could expect a higher spread of closer to 2% spread for that same 5 times long and short DLC on the Singapore names. Hong Kong names tend to be a bit more tight, and the indices definitely even tighter, less than 1% spread. Okay, on the index underlyings.
Yep, thank you for that.
All right, so I think we can move on to the next question. I think one of the question is by Gillian. What do you think of China's economy currently, and moving forward, how it will evolve?
Broad question.
Yeah, probably I take that. I think it's super hard questions. I think the economy is bottoming out. At least we have seen the worst data. It's just that I think the economic data itself is still lower than the expectation. So this is why the stock performance is kind of like also uneven as well. I think every investor at the moment is waiting for the big stimulus, either from the fiscal policy or the monetary easing itself. And I think the economic condition at the moment, right, is lukewarm enough to actually trigger the China leaders to really seriously look into that itself. So I would say there will be a whole bunch of investors out there investing in anticipation for the larger stimulus, but we just do not know when is the asset date or how big the stimulus is at the moment. But I would still say that, again, in terms of economic outlook, the next few years, the GDP growth number itself is still one of the best among the major economy. Long-term wise, I would say that it would be having a structural problem, which is the aging population. And I still do not know what would be the, how could they actually fend off this aging population problem as of now. Yeah.
Yeah, I think moving on to China, I think one of the question is, if US has a hard landing, how will it affect China? And what is your year-end target price for Hang Seng Index?
Okay, you are saying that if US have a hard landing, what will happen to China, right?
Yes, correct.
Okay, so basically, US is China major export country. So if US having a hard landing scenario, China will not be spared. So mean to say, right, I would say that China will encounter a slowdown in export due to US. But again, my base case scenario is that US will not have a hard landing. It will be a soft landing at best. So I'm not particularly worried about US affecting the China at the moment. I just hope that China will step up on the economic stimulus measures quickly. But if you are worried about China outlook, again, I would say that you can engage with some short selling instrument to bet on the drop in the equity market. For example, you can consider some of the short DLC like the Hang Seng Index DLC, Hang Seng Tech DLC, or some of the individual Hong Kong stock DLC for short selling purposes itself. Yeah. And sorry, you were asking about the target price for Hang Seng Index, right?
Yep, correct.
Okay. So for year end, I am still targeting 20,000. So 20,000 is my best case scenario. So I would say that it's probably 15 or 17% upside from now. But again, it will largely dependent on the stimulus measures to reach my best case scenario. But my base case scenario is probably 18,000. So it's about maybe a few hundred points from the current price. Yeah.
Okay, I think time is running out, so maybe we'll answer two more questions. Okay, so I think one of the question is, how do I choose which DLC to trade?
Okay, I'll take this one. Yeah. So so there are basically two types of DLC first, right? So there's a long DLC and a short DLC. All right. So if you're bullish on the underlying stock, Alibaba, for example, you will buy the long Alibaba DLC. If you are bearish on Alibaba, you think that the price will drop on Alibaba, then you buy the short Alibaba DLC. So first of all is whether you want to initiate a long exposure or a short exposure, then you will buy the corresponding long or the short DLC. Okay. So and then leverage factor for single stocks are all at 5 times, but for index you can choose either 5 times or 7 times. You can see in the name itself whether you want 5 times or 7 times leverage, up to you. All right. Then it comes down to the more tricky part where you look at the sensitivity of the DLC. So this one, it's a bit more in depth. I mean, I might have time to go through here, but rest assured that, you know, like all the long Alibaba DLCs, whether is it at 10 cents, whether is it at 50 cents price level, whether is it at $1 price level, it will all give you that same 5 times performance of the underlying stock, daily percentage performance. So if Alibaba moved by 1% today, all the Alibaba long DLCs will move by 5%. All right. Just that there are different price ranges and therefore have different sensitivity. So sensitivity is more important for those who are very active traders who want to trade it for, you know, a few minutes, a few hours. You want to have the most possible entry and exit entry points. Then the sensitivity will be of paramount importance to the active trader. So you can find out more about the sensitivity of the DLCs on our website. And I mentioned just now, if in doubt, look out for the red star indicator on our search page. That will tell you which is the most sensitive long or short DLC on that particular underlying asset. Okay, so 3 levels. Number 1, long or short, which one you want? Number 2, leverage factor, 5 times, 7 times, 2 times. That's also a 2 times one. And the last one is sensitivity of the DLC, which, if in doubt, look out for the red star indicator. All right.
All right, so we move on to the last question. I think one of the question is, what will China's stock market outlook be with Trump presidency? Maybe James, you wanna take this?
Yeah. So personally, I don't think we should worry too much about it at this stage, because again, you still do not know whether Kamala Harris or Donald Trump will be elected. And should there be a US-China trade war, what kind of tariff is going to be imposed? So I think the common understanding here now is that if Trump is elected, it may not be so good for China, because US is going to impose more tariff on the China goods itself. So maybe US under Trump administration will start a tech war. So certainly certain US technology components will not be exported to China, or maybe in the worst case scenario, China will retaliate and eventually causing an intensifying US-China trade war itself. But there are too many maybes, too many assumptions. So I guess it's best not to worry too much about it at the moment. In any case, it should happen after the election, happen after January itself next year. And you should probably wait until then to assess the full situation when it really happens. So all in all, if Trump is elected, the consensus would be it will be bad for the China economy and bad for the stock market. Again, how bad it is, no one can give you a good answer now. But I would say that maybe you should also look at the bright side. Maybe at the point of time, maybe when there is some US tariff on the China goods, China has already popped up the economy by a lot with a lot of stimulus, and probably there will be a strong domestic demand. So investor at that point of time may not be worrying too much about a Trump presidency itself. However, again, I would say that if you are too concerned about the geopolitical risks, you may want to avoid China itself, or if you have a negative outlook, again, you can engage with some short DLC. The way I look at it is that you need to ask yourself, is China valuation itself appealing enough for you to overlook some of the potential geopolitical risks? To me, the valuation at the moment is appealing. But again, I would like to stress that you should also consider your position sizing. You should control your position sizings. Yeah.
All right, I think that's the last question that answered. Okay, so it is now 8:24 p.m. Once again, we thank James and Marcus for sharing today's webinar. Do look out for the next webinar that is happening on our Tiger Trade app under the Live tab. Do look out for it. And thank you once again to the audience for taking time to tune in. With that, we will end the webinar. Thank you.
Thank you, everyone.
Thank you all. Thank you, Marcus. Thank you, Joseph. Thank you, everyone. See you again.